I've been investing for 2 years now and built up a portfolio worth $20,000. I ultimately sold all of my shares to use as a deposit on my first house that I bought at the age of 22. Before I got started, I had so many questions like, what stocks do I buy? Won't this take up all my spare time? And what if I end up losing all of my money? But I found out all of these things were completely false, and that anyone can get started with investing even with $100 or less. After this video, you'll go from investing beginner to investing pro, no matter how little experience you have. When I was a kid and through my teenage years, I always thought the only way to become wealthy was by keeping every penny that I made and putting it into a high interest savings account that might only give me 1% at best. But then a friend told me that people who invest in the stock market on average will get 10% every year. And I couldn't believe that. I thought it was amazing that I could get 10 times the return in the stock market compared to a bank. The same friend also told me about companies like Tesla that could go up over 200% in just a few months, and all of that information just blew my mind at the time. Before I was completely sold before investing, I wanted to know what stocks were and how they actually work. When someone buys a company's stock, they essentially become part owner in that particular business. So if you invest $100 into a company and its share price goes up by 10%, then you'll be rewarded because you gave that business your money. So when the share price goes up by 10%, so does your investment. So that $100 turns into $110. And this can also happen in reverse. If that business isn't having a good financial year and it's lost 10% of its value, then your $100 investment is going to become $90. Some of the things that can make the price of a business go up or down is the economy, what are the interest rates, how high is inflation, what are the news articles posted about the particular company, and also what people's perception is of the business on social media. And companies offer shares of their business to help generate more money that they can use to grow their company. Big corporations like Google, Amazon, Facebook, Tesla all offer shares to investors. So that led me on to my second question: what stocks should I buy and what's the best investing strategy? I always used to think that buying stocks was just staring at a computer screen for hours at a time, trying to pick the best buying and selling points, perfectly trying to buy a company at the very bottom and sell it at the top for a quick profit. But what I ultimately found out is that investing isn't just about trying to make quick money or gambling on one magic business. And one of the best strategies I also found for making consistent returns in the stock market is dropping a like and subscribing to the channel. One of the best things that I found a beginner can buy is something called an ETF, or an exchange traded fund. These are great because you spread your money out across lots of different companies, so you're not just risking everything on one stock. There are lots of different ETFs available and they all have a particular investment goal. For example, you can get ones that will track a specific sector in the market like technology through BGT, or you can also have ones that look at a specific commodity such as gold through the iShares Gold Trust ETF, and then you can also have ones that will target dividends such as SCHD. One of the most popular ETFs that money can buy is VOO, or the Vanguard S&P 500 ETF. In a nutshell, it just tracks the biggest 500 companies in the American stock market, and on average, it'll give you 10% per year. Now, that might not sound like a lot, but that really adds up over time. When I heard that you can make 10%, I still thought, how am I going to get rich from investing into something like VOO? Even if I have $10,000 and I make 10% on it, that's only $1,000 profit, which in the grand scheme of things isn't really that much money. You're not going to retire from making $1,000 a year from one investment. But then I learned about something called compound interest, which is essentially where you earn interest on your interest. So if you take a look at a one-time investment of $1,000 over a 10-year period, that initial $1,000 will turn into roughly $2,500, which isn't a bad return, but you can really see the power of compound interest once you invest for a little bit longer and start contributing money every single week. Then the results can get quite surprising. So if you keep in mind that $1,000 invested, but you add in $50 of your own money every week, then over 10 years, you're going to have just over $40,000 in profit. But the surprising thing is that $25,000 of it is from compound interest and only $15,000 will be from your own money. If you bump up the contributions a little bit more to $100 per week and do it across 20 years, then you'll have just over $280,000 in portfolio value and over $180,000 just from the compound interest, and about $97,000 of your own money will be put in. Now this is much better than what you would get with a savings account. If we keep that same example but compare it to how much you'd make with the 1% interest on a savings account, so $1,000 initial investment over 20 years and actually putting in $100 a week of your own money, then you'll only have $51,000 of total portfolio value, but $49,000 of it will be the cash that you put in and only $2,000 is from compound interest. So you have $281,000 from the VOO ETF and only $51,000 from a high interest savings account with a bank. So you can really see that compound interest is your friend, and it's much better than just trusting your money with a bank instead of the stock market. What I found with ETFs is that it's kind of like a high interest savings account. You don't always need to check how much money you've got or try and jump between different companies. It's just a set it and forget it strategy, and all you want to do is have a automatic payment from your bank account into an ETF and just keep on adding a little bit of money every single week and keep it in there for 10, 20, 30 years. You're not trying to jump between different investments, but you just want to hold one company and consistently put a bit of your own money into it every single week. And jumping into our second option, which is individual stocks. Now, while 10% every year sounded quite good at the time when I first heard about it, I also saw companies like Tesla go up 10% in one day instead of 1 year. And it even went up 400% in just a few months on its own. So that really piqued my interest, and I branched out and started investing into individual stocks instead of just sticking with ETFs. I found that there was two types of individual companies that you could buy. Firstly, there were growth stocks like Nvidia and Tesla that could go up several 100% in just a few months. And then there's also blue chip companies like Coca-Cola, McDonald's, Pepsi that are tried and true investments. They've stood the test of time and they've been around for decades. They've had the majority of their growth already, and they're not going to shoot up several 100% in just a year. They've already had their big jumps, and they're more of a stable, slow and consistent investment when it comes to individual companies. When it comes to growth stocks, things can backfire quickly if you don't do your own research. There can be lots of hype and speculation, and people can buy into a growth stock even if it's very overpriced or currently the market isn't very stable and we might be heading towards a recession. There can be more speculation that bumps up the price of a growth stock than its actual value. So it's always very important to always do your own research, and don't always just trust other people only because they have a big social media following. No one has a crystal ball and can tell you the future. Of course, you can always make an educated guess, but at the end of the day, no one can give you a guaranteed answer. So if you just take other people's word for it, then you're not going to really understand how they made their decisions. And if you don't understand how they reach their conclusions, then you can't really follow or make your own educated assumption on what you think a particular business will do in terms of if the price will go up or down, or if it's a good buying chance. I personally had experience with Tesla from 2020 to 2022, where the price of the company had some amazing jumps, but it was very stressful because I had about $20,000 invested, and it was quite an emotional roller coaster, to say the least. It was basically all my life savings, and at one point I was actually down $9,000, but other times I could make $1,000 in just a few days if the stock was going well. So it was quite a gamble. In the end, it worked out and I could sell for a profit, but there will be lots of people with how Tesla is now that would have lost a lot or all of their money. So it can be interesting, but you can't just take other people's word for it, and you have to make your own decisions when it comes to something volatile like a growth stock. So the third and final thing is, how do you actually buy shares of a company? I'll walk you through this process using a really good broker that's easy to use called Stake. You can sign up using my link in the description box to get a cool bonus like a free stock with either GoPro, Dropbox or Nike. So this is what the home screen of Stake will look like. you can see my current portfolio that I've got. It's just over $600 US. I did sell most of my investments earlier last year. So if you want to start investing in a company, all you have to do is just search for it. So in the top right side of the screen, you can click the search icon, and I'll be looking for VOO, the same ETF that we used earlier in the video. So I'll just type it in up here, VOO, and it's the first one that pops up. So we click on it, and then all you need to do to buy it is just click on the buy icon, and you can get some shares of the business. But you'll first be greeted by a stock chart that will just give you a rundown of the price movements of that particular investment. So you can look at it over different time points, so 1 day, 1 month, 3 years, and Stake also does have a candlestick graph option as well, if you're interested in that. And then it'll give you some general financial information about the company, like the 52-week high and low, its dividend yield. For the majority of people, market buy is what you want to go with, so that's just buying the shares of the business at the set market price. So for VOO, we'll buy the shares at $371, and then you just put in the amount that you want to pay. So I put $20, and then you just hit review buy, and you will have purchased the shares of the company. And that's really how easy it is to buy shares of a company. It's just a few clicks of a button, and you can do it within a minute. After I learned about all of this, I still wanted to know a consistent way to always make money in the stock market no matter what. And I found out about dividend investing, which is the easiest and most straightforward way to always get a passive source of income, even if the stock market is going up or down. Even in a recession, with dividend investing, you can make a consistent amount of money, and actually enough to purely live off your dividend income. If you're interested in learning about this topic, then check out this video on screen.